So today we are talking about merchandising. We will be talking about merchandising companies. So far, the examples that we had were all from service companies, right? What's the main difference between service companies and merchandising companies? Merchandising companies are companies that sell products. All right. You have inventory. What else? Yes.
There's a high volume of transactions.
Service companies might have also high number of transactions. This could be the case, but not always. But this could be the case. They usually, so before having inventory, what do you need to do? Buy the inventory. So you need to buy the products before you are able to sell them. Best Buy, before they can actually sell you a TV, they have to buy it from Samsung or from LG, right? They cannot directly sell you the TV from nowhere. So there's an extra step here where they have to deal with their suppliers. Service companies, they don't. What they have is, they provide you with the service. So the accounting for those two will be a little bit different. Okay? Today we will learn how to do the accounting for merchandising companies. We will learn how to generalize sales and purchases for merchandising companies, and then we will learn how to basically we will learn about a classified income statement, okay, or a multiple step income statement. Now, when we talk about merchandising companies, there are two types of merchandising companies. Exactly. So basically, you have wholesalers and retailers, right? When you go to Best Buy and buy, are you buying from a wholesaler or retailer? Retailer, because they sell to individual people. Wholesalers, they are the people who will sell to Best Buy or people who will sell staples and stuff like that. Okay? So, the main difference between service companies and service companies and merchandising companies is that the main source of revenue. For service companies, the main source of revenue is service revenue, right? It's not rocket science. Come on, service company, service revenue. Sales, merchandising company, which is sales revenue, right? They get most of their money from sales. And when you say, and by the way, when people talk about sales, they are actually talking about sales revenue. So when you hear that they made sales for $20,000, that means that's sales revenue for $20,000. So this is the main difference between the two. Okay? Any questions? Now remember that certain merchandising companies, they also provide services, right? Right? Like, we can give an example. Geek Squad, right? Best Buy. They sell products, but at the same time, they also provide services. So in this case, you have both. Now, in this slide here, how do you calculate net income? So far, with the service revenue, with the service companies, it was very simple. We had service revenue minus expenses, and so far it was operating expenses, right? Salaries, depreciation, there were rent, right? All these expenses, they were subtracted from revenues, from service revenues, to get to net income, right? In this case, there's an extra step here. There's this extra step here. This extra step here is only for merchandising companies. This one includes the part where they will account for buying the inventory. So the cost of goods sold, this is the cost to the company. This is the cost that Best Buy has to pay to purchase those TVs before they can actually sell them to you. So this is the cost to the company itself. The cost of the goods that the company will sell. That's an expense. So what kind of normal balance does it have? An expense will have a normal debit balance. Okay? So the cost of goods sold usually is the sum of all the products that the company sold, the cost of all the products that the company sold in a certain period of time. If it's a month, during that month. If it's a year, it's during that year. Okay? Before getting to net income, usually companies also calculate gross profit. Gross profit is simply the difference between the sale and the cost of the product. This is before calculating operating expenses. And why do companies separate cost of goods sold from operating expenses? Okay, to make sure that they are not selling the product at a price that is lower than the cost itself. Right? So this is one reason. Another reason is that the cost of goods sold is directly related to to the sales. In what way? If the company, if Best Buy, sells in August, if the company sold 100 TVs, they have to recognize the cost of 100 TVs. If they sold in September 150 TVs, in September they will have to recognize the cost of 150 TVs, right? It is directly related to the sale of those products. On the other hand, operating expenses are like rent or salaries. Rent, for example, Best Buy will pay the rent of their storerooms or showrooms no matter how many products they sell. So if they sell 100 TVs or 150 TVs, it does not matter. They are still paying the same rent. Rutgers will pay me the same salary whether there were 5 in the class. Actually, 5 in the class will be cancelled. So, whether there were like 20 students in class or 200 students in the class. As far as Rutgers is concerned, it's not directly related to tuition. Okay? So this is one thing. This is an example of operating expenses compared to sales expenses. Rutgers is not a sales and merchandising company. They don't sell products. Basically, in general, they are service companies, right? They provide you with an education. But merchandising companies, they will have to pay for their employees. They have to pay, no matter how many products they sell, they still have to pay for the rent, for utilities, etc. Regardless of sales. Regardless of the number of products they sell. Okay? So, operating expenses are what we've been using so far, like utilities, salaries, depreciation, all these things. So companies, they do it on basically merchandising companies, they calculate gross profit to make sure that what they are selling is not lower than the cost itself. They want to know how much it costs them to make those revenues, and that will give them the gross profit. After that, they subtract operating expenses from gross profit to get to net income. Okay? Let's start doing that. Again, the operating cycle for the service company is it's shorter than that of the sales of merchandising companies. And why is that? With service companies, you do not have the step of buying inventory, this part here. It's not included. So what does it mean? You provide the service, you send the bill, you receive the payment, right? This is for service companies. When it comes to merchandising companies, you have to buy the inventory, pay that inventory, then you have to sell the inventory. But after you sell the inventory, you send out the invoice, and you receive cash. So it's longer. And this extra these extra steps are directly related to selling products. Now, how do you calculate the cost of goods sold? It's very important to know how much it actually costs you to be able to calculate net income. So operating expenses are easy to, more or less, they are easy to calculate or estimate. Why is that? You will receive a bill from the utilities company that will be for utilities expense. You know how much is supplies you use, so that's supplies expense. You can calculate depreciation, that will be depreciation expense. What about cost of goods sold? Remember that the matching principle requires companies to match. So what's the matching principle? Expenses with revenues. So you match expenses with revenues. This is why the companies would have to match their sales and their cost of goods sold. Right? This is an expense that is directly related to the sales. How do you calculate cost of goods sold? How do you find out the cost of the goods that you sold? Usually at the beginning of the year, you start, or let's say month. So at the beginning of the month, you start with a certain number of TVs in your storehouse, okay? In your storeroom, for example, in your warehouse, you have 100 TVs. During that month, so you started off with, let's say, beginning was 100 TVs. During the month, during September, for example, beginning of September, you had, during the month, you purchased, let's say, 40 TVs. Okay? Do you know the cost of those 40 TVs? Here we don't know, but usually, do companies know that basically the cost of the TVs? Yes, they receive an invoice. This is how much they purchased them. Okay? So say that in this case, each TV, on average, we're going to use like the average numbers now. On average, each TV costs them 100, or let's say $500. So we have 100 TVs multiplied by 500. 40 TVs multiplied by 500. Okay? Now, how much does the company have, or how much in September can the company sell? How many TVs? 140, exactly. They had 100, they purchased 40. So during this month, the cost of goods that are available for sale, this is the cost of goods available for sale, is equal to those two together. Right? So it's equal to 100 plus 40 TVs. And I'm doing that on purpose. I'm leaving the 500 to the side because that makes it, you'll see later on that it doesn't really matter at this point. Later on, we will learn how to include the amounts. But what I want you to understand right now is the concept. So those are, this is the number of TVs that the company can sell. That's why we call it available for sale. Now, by the end of the month, let's say that end of September, the company, they looked at what they had in the storeroom, still basically their ending inventory. They found that they had 50 TVs. What does it mean? How many TVs did they sell? 90. So that means that they sold 90 TVs. So 90 TVs multiplied by $500 each, right? That's $45,000, right? This is the cost of goods sold. This is the cost of the TVs that the company sold. It's the cost of goods sold. This is the expense directly associated with selling those TVs. So you know, for example, let's say that the company sold the TVs for, so selling price was $700, right? In this case, they sold. So their sales revenue would be, this is really nice. So sales revenue is equal to 700 multiplied by 90 TVs, right? Which is 63,000. In this case, this is when you calculate the difference between the two. You know that the gross profit in this case was 63,000 minus 45,000. This is the revenue, this is the expense. Okay? Do you guys understand the concept? Okay. Now there are two ways of calculating actually the cost of goods sold and calculate the ending inventory. There is one system that is called a perpetual system. Now what do we mean by perpetual system? Perpetual system, it means that the company would perpetually, continuously, they would update their cost of goods sold and their available, basically, and their inventory, the balance of their inventory, after every sale. So the company, for example, like we said, they had 100 TVs, they sold 10 TVs, they immediately journalize the expense, which is cost of goods sold, and they also recognize the revenue and the change in inventory. What was the change in inventory? They had 100 TVs, they sold 10. What was the change in inventory? It decreased by 10. So it decreased by 10, right? In this case, the cost. Remember that inventory is an asset, and assets are recorded at cost. Which principle is this? Historical cost principle, right? So this is an asset that will be recorded at cost. Now, the perpetual system has several advantages. Who can tell me an advantage of the perpetual system? A system where the company always and at every moment, yes? Sorry? Exactly. You always have an updated record of your inventory. Okay, give me an example of a company that tells you this information.
Sometimes Amazon will be like 19
Items left. Exactly. So Amazon, they are well known for their advanced inventory system. Amazon, they don't want to sell you a product that they don't have. As a result, they have an updated and advanced system. They have an updated, basically, they have updated information at every moment. So if you buy one, let's say that you're buying a certain item, and there are still like 19 items left in stock, right? You buy one, it will automatically update and show on the screen that there are only 18 remaining. Why is that? They don't want to oversell what they don't have, because it will cost them more to buy it from somewhere else, or you might basically complain about their services. So in order for them to keep you happy as a customer, they keep an updated record that is updated after every transaction. There are certain companies that deal with a lot of small stuff. For example, if you are a hardware store that sells nails, right? But for example, Home Depot. Do you think that Home Depot will update their service after every time they sell a nail or like some basically a light bulb? It's not worth it to them. So what they do is they do what we call a they use the periodic system. The periodic system is basically when they go at the end of the month and they count whatever remaining inventory they have. So they go there, and they start, basically this is why you see sometimes certain stores are closed for inventory. What they do, they start counting how many items they still have. That will give them, so now as you can see from the slide before, that will give them what? It will tell them how much inventory is still remaining. They already know how much they had available for sale. So what does that give them? Cost of goods sold. If you know this information, you can simply calculate the cost of goods sold. Because you see the cost of goods available for sale, this is whatever they had during that month. It will be two parts. One part will be the part that the company sold. This would go to the cost of goods sold. The other part is whatever remains in their warehouses. That's the ending inventory. Okay? Now the perpetual system, like I said, after every transaction, they will calculate cost of goods sold and inventory. Okay? There is an issue here, which is what? Because this is much better than running an inventory at the end of every, if possible, right? This is much better than periodically checking at the end of every month. And why do companies sometimes use? One of the biggest disadvantages, and I'll get to that point in a second. One of the biggest disadvantages of perpetual systems is the cost. It costs a lot to keep updating your system. And one of the things that is helping basically these systems spread are what we call point of sales. Do you know what points of sales are? How many of you know what points of sales are? How many of you went to Walmart? Seriously? You've never been to Walmart?
I did.
Exactly, thank you. I did. I do. Basically, whenever you go to Walmart, to BJ's, Costco, etc., all these places where they scan your products, their systems can be easily updated. Now, it doesn't mean that they do that every time. It's not all companies. But the spread of these computerized systems is making it easier for companies to adopt a perpetual system. Okay? Now, companies that have large, basically big value items, like, for example, cars. Ford, for example, they want to know exactly how many cars they have at every moment. So those companies, they always use perpetual systems. Okay? They want to track at each point in time how many they have from each model they have, from each color, etc. Periodic. Now to go back to your point, perpetual systems do not account for theft or basically incorrectly recording something or fraud and stuff like that. This is why even companies who run a perpetual system, they still, at the end of the accounting period, they still run a physical count. And the difference between the physical count and the actual book value, or whatever is on the books, the balance according to the company's books, will have to be adjusted for. So the company will have to make an adjustment to update the balance between what they think they have and what they actually have. The difference is that during that time, they have more or less an updated information. They don't have to wait until the end of the month to know how many items they still have in their inventory. It's not going to be 100% accurate, but it's still better than having just the balance from last month. That's the idea here. Okay, so this is the periodic system, and this is how we did the example. You have the beginning inventory, and then you add to it all the purchases during that year. Okay, and when we say purchases, net, that means net from any returns. Because sometimes you might buy something, you find that it was defective, and then you return it, right? So add purchases, and then that will give you the goods available for sale. This is divided into two parts: the ending inventory and the cost of goods sold. It's easier usually to count the ending inventory, because companies usually they sell more than they keep in their warehouses. So the number or the amount of cost of goods sold is usually higher, much higher than what they keep in their warehouses. Any questions? This is basically, it shows how the company is recording sales after every transaction or at the end of the month. So here, as you can see, after every item is sold, the company will record the revenue and they will calculate the change in inventory and cost of goods sold. When they use the periodic system, they will only recognize the sale. So they will recognize the sales revenue, they will not update their inventory. Inventory is only updated at the end of the accounting period. Okay? Now, as you can see, the perpetual system, the companies will not make a journal entry. They don't have to make a journal entry at the end. They will be making an adjusting entry. Adjusting entries, remember, you remember that they are treated separately from regular entries, from regular journal entries. Do you remember that? That's why we had it like a header or subtitle that says, basically a title that says adjusting entries, to separate it from regular transactions. Okay? We mentioned this. Any questions about this? Now we will learn how to actually, the book, because of the increasing popularity in based on among companies to use perpetual systems, the book decided to use the perpetual system for basically to illustrate the concept of recording purchases, etc. However, we will still cover the periodic system in the appendix. By the way, in the syllabus, I think I made a mistake. I put appendix A. That's not appendix A that we're responsible for. It's appendix B, which talks about the periodic system. And the next chapter will talk mostly about the periodic system and how we estimate inventory amounts. So, how do companies record a purchase? This is when Best Buy is buying the TVs from Samsung or from their wholesaler. How? First thing that they need to start with is a certain business document. Remember that? Before they actually journalize or make anything, they have to have a proof that this transaction actually happened. Usually this happens in the form of an invoice. Companies might not, most of the time they don't actually prepare a new invoice. They just use the sales invoice that their vendor sent them. In this case, we are looking at it from the point of view of the buyer, not the seller. The seller prepares the invoice. This is how it happens when you go, for example, buy something, right? The seller will give you the invoice, they will give you the check, right? They will give you the original copy, and they keep another copy for that, for their own records. The buyer, in this case, it's South Stereo. What they will do is they will take this invoice and record the information in their systems. A sales invoice is a proof that the transaction actually happened, and it will have different information. For example, it has the name of the buyer, has the name of the company, has certain information that is like invoice number. Okay? Has the amounts. See here, the amounts. The items, line items. You also have information about like the address of the buyer. You have this one here. This is the terms of the sale. When you read 210, and we'll talk about that a little bit later on. 210 and 30. Extract 210 and 30. That means the buyer will get a 2% discount if they pay within 10 days. However, the full amount will have to be paid by within 30 days. It tells you about the shipping. Who's paying for the shipping? And we'll talk about this in detail later on about each one of them. Has a date. You see, this information is very useful. Now, do you think that with this kind of information entered in the system, do you think that the same invoice can be entered twice, or there can be like what we call a duplicate invoice? Do you think that the system will accept a duplicate invoice? Basically, will you have companies, if they enter all this information, will companies have duplicate invoices? What do you think? It's very unlikely. Actually, it does happen a lot, more than you can imagine. I did some research with the company that they were telling me I was using their payments and their invoices database, and they were saying that they had no duplicate invoices. There is no way. They use Oracle, they use SAP, etc. So they use the best companies that should prevent this from happening. It does actually happen. I did find a couple of duplicate payments. In certain cases, for example, you have a missing number from the invoice. You have a different, the name is spelled different. One company we worked with, they had a lot of invoices. The way it used to happen, they used to receive a copy of the invoice by fax, okay, to speed up the payment system, basically the payment between them and their supplier. And their supplier will then later on send them the original invoice by mail. But to speed up the transaction, they will send them a copy by fax. Now, the company would receive the invoice by fax, would receive the invoice by mail, and then both of them, the system would allow both of them to be entered. Usually systems would reject the entry of the same invoice number twice, or the same information twice, usually. However, what do you think happened in this case? And the company kept receiving those duplicate invoices, and they used to make those duplicate payments. They paid the same invoice twice for a long period of time until they detected that. Actually, there was on the scanner that the companies used to scan and fax, basically the fax machine. When it scanned, there was some dust on the scanner of the fax machine, and the dust would hide a number in the, for example, let's say it would hide the first digit in the invoice number. It will read it different. Now the number is not 3731, it's 31. The system accepts it. Some dust on the scanner of the seller introduced this problem. The reason why I'm saying that is that it's very important to understand this concept. This is why it's very important to have controls afterwards to detect and try to identify that you're not making the same entry twice. When you're dealing with big companies, it's fine. Because they will credit your account if you make an extra payment. But smaller vendors, it's not always. Sometimes they will think that this is a gift, an early Christmas gift. Who knows? So basically, this is the information, and this is why now companies try to include as much information as possible. They don't just include the name of the vendor and the date. They try to include the name of the vendor, the date, the invoice number. They try to include, if they have any reference number, they include that. So they try to make it as basically separate, as distinguishable as possible from any other invoice. Okay? Now all this information is used to prepare the journal entries. So let's do this one. South Stereo, which is the buyer, uses as purchase invoice. They use the purchase invoice as a document to make their journal entries, to record that transaction. This is the proof that the transaction happened, And then what do? They have to record it, right? What do? They bought, and remember that the company, so you see, remember one thing. Remember when we talked about the difference between a truck used for sale and a truck used for the business operations? If it's used for business operations, it will be classified as equipment. If it's used for sale to be sold later on, it will be inventory, right? Best Buy, for example, they have their own computers that they use for their business operations. That's treated differently from the computers that they sell. They also have TVs on display. Those TVs are used for different purposes. They are recorded different than TVs that they are selling. In this case, those are products that the company is going to sell. So this is inventory. They are buying inventory. Okay? When they buy those items, what happens to their inventory? Increases. Inventory is what kind of account? It's an asset account. So what do? You debit, right? You debit inventory. Did the company pay for that in cash? What does it say here? You have here. So they didn't pay. When they send them an invoice, it means they did not pay in cash. So it is accounts payable. And you have the full amount, 3,800. Okay? Any questions? So this is to record the actual purchase. Now, you see this thing here? FOB, shipping points. FOB means free on board. That means free to which points? When you say free on board shipping point, FOB, shipping point, it means the shipper, who is the seller, right, will put those products on the delivery truck for free. What does it mean? Who's paying for the shipping? No, they are putting it for free. Who's paying for the shipping? Someone has to pay for the shipping. The buyer. So when it is free on board shipping point, it means that the shipping point can put them on the truck for free. When it says free on board destination, that means for the destination, which is the buyer, for the destination, the products are free. The shipping for the products is free. You see, this is very similar to when you buy something from eBay, right? In certain cases, you have to pay for it. You have to pay for the shipping. In certain cases, it's the seller who pays for shipping. So it depends whether you are paying for that or the seller is paying for it. The accounting for this changes. Why is that? So in the first case, when it is free on board shipping points, remember, free on board FOB, shipping point, it means free for the shipping point. Who's the shipping point? Who's shipping the products? The seller. So it's free for the seller. If it's free for the seller, who's paying for the shipping? The buyer. When you say FOB destination, don't get mixed up. Don't get them wrong. If you say that, for example, it's free on board for the destination, it means it's free shipping for the buyer, for the destination. Who's paying for it? The seller. Now, when you say that it's free on board shipping point, who's paying for that? FOB, shipping point, the buyer. That cost of shipping is added to the value of inventory. Now, why is that? Inventory is recorded at what? Is it at purchase price? Inventory, like other assets, is recorded at cost. The cost does not mean the purchase price only. The cost means whatever the company had to pay until it reached their warehouse. So that includes what? Shipping, if they had to pay for shipping. So if they had to pay for shipping, this will increase the cost of inventory. The cost of inventory is the value of the inventory. This is not, here we're not talking about, when you talk about inventory, it's the actual value from a purchase perspective, from a buying perspective. The company, they want to replenish their inventory. Basically, this is the cost of the inventory to the buyer before they sell it later on to the consumer. You understand the point here? Okay, so in this case, when the company receives FOB, but receives the product, FOB shipping point, it means that they are paying for that shipping. In this case, it is an expense, right? Right? Wrong. I just mentioned that it goes on to the inventory. It's not an expense. It is part of the inventory. It's part of the cost for those inventory items to reach their warehouse. As a result, the company would make this entry. The value of the cost of the inventory has increased. So the value of inventory has increased. Remember, the cost of the inventory is what the inventory will be recorded at, right? It's an asset, it's recorded at cost. And when it's recorded at cost, the higher the cost, the higher the value it's recorded for, right? So here you have an extra, how much did they say? Okay, here. It's $150. They paid that in cash. What happens to their cash? Cash decreases. So you credit it. Because they are paying in cash. So their cash decreases, so you know that you are going to credit cash $150. What do you debit? Inventory. Because the value of your inventory has increased. So this is here, cost of inventory has increased. So the cost of inventory has increased, okay? Whereas if the seller, this is the seller is paying for the shipping, how will they actually record it? Now it's an expense. It's an operating expense. So now it's what we call freight out expense. Sometimes they also call it delivery expense, but usually it's called freight out. So either one of them would work. So this is called freight out. This is the cost of shipping a certain product. How do they pay for it? Cash. So cash will be credited. So this is FOB. Shipping point. So it's shipping paid by the buyer. And this is FOB, destination. So shipping paid by seller. Any questions? So when the buyer is paying for the shipping, the cost of the inventory will increase. So this shipping cost will be added to the inventory. Okay? On the other hand, this is when on the other hand, if the seller is paying for shipping, this is an additional expense. This is a freight out expense. Okay? Any questions? Remember, we are doing all this under the perpetual system. The periodic system will record them slightly differently. I actually want them slightly, but they will record them differently. Okay. Now, like with any transaction, the customer might not be satisfied with a certain product. As a result, they might return it, right? How many of you have ever returned an item? We all did, basically. Those of you who did not should try it. So basically, this is when you actually return certain item. If it's defective, if it has certain problem, if the size is not is not good, if there was any any wrong description, if it was described differently, if it was different from the description on the website, stuff like that, right? You have all these things that will give you the right to return them. So in this case, if you return certain goods, what would happen? The seller might either basically issue you a full refund, right? Most of the time this is what happens, or at least like happens pretty often, right? You will return the product, they will issue you a full refund. There's another option where the seller might tell you, okay, you may keep the product and I will give you an additional discount. Because it's defective, for example, let's say that you bought, for example, a TV and then there was a dead pixel in it, or it was scratched or dented. What happens is that you might ask the seller to return it, they might give you an offer, keep it, and then they will discount it like by $100. If you don't care about the scratch in the back, say that, okay, I'll keep it. So what? Right? So those are treated differently. You have purchase return and purchase allowance. Purchase allowance is when you have a deduction from the cost or from the price the seller sold you those products, so that you would keep it. Okay? How do companies generalize such transaction? So assume sub-stereo return goods costing $300 to BW Audio Supply. Remember, so far we're doing the purchases, right? Purchases, that means we are reporting it from the point of view of the buyer, not the seller, the buyer. So in this case, what's the transaction from the point of view of the buyer? Let's say that you bought 100 TVs, you decided to return 20. What happens? What happens to your inventory? That's decreased, right? So you had 100 TVs, you return 20. How many TVs do you still have? 80. So the value of your inventory has decreased by 20 TVs, right? In this case, Sub Stereo, they returned goods and products for $300. So what happens in this case? Their inventory will decrease by, what happens is that the value of their inventory decreased, but at the same time, what they owed to their vendor has also decreased. Originally, they owed them from this one here, if you remember, they owed them $3,800. They returned $300 from them. The value of their inventory decreased by $300, but also their obligation or their debt to their vendor, what they owed their vendor, has also decreased by $300. As a result, the journal entry will be to debit accounts payable to decrease the debt that they owe their vendor, and to credit inventory. Right? Any questions? Okay. So in the perpetual inventory system, when you return a defective product, what will happen? This will be recorded, this will decrease your inventory. So you credit inventory. Okay? Now, purchase discounts. Purchase discounts. So for purchase discounts, this is the other part of it. Okay? Remember the 210 and 30? This is when the seller gives the buyer an incentive to pay faster. Then while they are going to lose some money, it's 2%. They win the advantage of shortening the operating cycle. They shorten the time that they need to collect the money. Instead of waiting 30 days, Now they will receive it within 10 days. They can use this money to buy new inventory and sell it. Okay? Usually, when this happens, the purchaser it's better for the buyer also to take advantage of this. And why is that? That will be equivalent to paying a very high interest. So it's even cheaper for those for the buyer to take a loan from a bank and pay that money. It's cheaper for them than actually to let go of this discount. So in this case, what happens? If the company actually you take advantage of this, the buyer will be saving money, the seller will be getting their money faster. So it's a more or less like a win-win situation. So there are different ways of doing that. Sometimes you have 2, 10, and 30. That means you get 2% discount if you pay the full amount within 10 days. Otherwise, the full amount has to be paid within 30 days, net in 30 days. And we say net because this is net from any returns. If the company has returned, if you have returned anything, you don't owe that money anymore, right? So it's net from any returns. 110. 110, it means that you get 1% discount. EOM means end of month. Within the 10 days from the end of month. Basically, it's within the first 10 days of the next month. Maybe, like for example, the company pays their employees every on the 15th of every month, right? So they want to have some cash. They want to make sure that they have cash enough to pay. So they give this kind of incentive that it will be paid within the first 10 days of the month. In that case, they will get enough cash to pay their employees. And then you have net 10. N10, it means that you have to pay them within the first 10 days of end of month. N10 EOI. Sometimes it just says N30. That means there is no discount. And the last one here, you have no discount. You have to pay the net amount basically within the 10 days of the next month. It could be also N30. That means you have to pay the full amount within 30 days. No discounts offered. But when there is a discount, like in this bill, if you remember, it was 210 and 30. So let's say that the buyer does not take advantage of this discount and they don't pay it within the discount period. What do they have to do? So they don't have to pay. They don't pay it within the discount period. It's 3,500. Then they have to pay on June 3rd, which is after the discount period. Okay? The company will pay, basically, sub-schedule, they will pay the full amount, right? Which is 3,500. Why is it not 3,800? Originally it was 3,800. They returned 300. So it is the net amount, which is 3,500, which is actually the 3,800 minus the 300. Okay? They paid in cash. That's when you pay the bill. Your cash decreases, you credit cash, your debts also decrease, so you debit your liability accounts payable. If the company, on the other hand, take advantage of that, of the discount, so they have 3,800 net minus 300, so that's 3,500, right? The amount of cash that they will pay will be 3,500 minus the 2%, minus the discount. The discount was 2%. So this is here. It was 210 and 30. So the discount is okay. The discount is 2%, which is $70. So the company will actually pay 3,430. This is the amount of cash that the company pays. What's the amount of debt that will be erased? 3,500. They don't owe the seller anything anymore. What about the difference? The $70, it's recorded as decrease to inventory. Why? What's the cost? Remember that inventory must be recorded at cost. What's the cost of those products now? Are they still 3,500? What's the cost of inventory? 3,430. That's the cost. As a result, the 70 is to decrease. So those 70 are to account for the decrease in the cost. This is the decrease in inventory cost. Okay? Any questions? So you see now the difference. What do you do when you have to record the discounts, the purchase discounts? You debit the liability, the full amount, to decrease it. Then you credit cash, the amount, the full amount minus the net amount, minus the discount. And then the discount will be credited to inventory because it is actually decreased the value of your inventory. And this is, we just talked about this, why it is useful to actually take those, discounts. So this shows the different entries to the account inventory. First one is the purchase. And then after that, we had to pay for the delivery, shipping. The original cost of the inventory was 3,950. And then we returned 300, and we got the discount was 70. So the cost of those products that the company purchased is 3,580. Let's say that you purchased, that you bought, for example, 10 items for this value, each one of them would be 3,580 on average. We will learn later on how to calculate. But think about it this way, okay? For now. We will learn later on how to calculate the actual cost. So on September 5th, the La Jolla company buys merchandise on account from Diaz company. The selling price of the goods is $1,500. And the cost to Diaz company was $800. On September 8th, the La Jolla returns defective goods with a selling price of $200. You have to record the transactions. We have to journalize them on the books of the La Jolla company. When you have a question like that, look at which perspective you're looking at. Are you looking at the seller's company, or basically books, or the company, or the buyer's books? In this case, it's what? The buyer. So here I have to look at it from the buyer's perspective. What happened? What was the first transaction? Purchase of merchandise on account. Right? So we know that inventory increased and accounts payable increased. You have more liabilities now. You owe a new debt. You have a new debt. That was for selling prices $1,500. What about the cost? $800. We don't care about that. This is not for the company. This is for the seller. So the seller is concerned with this one, not the buyer. In this case, you have your debit. Inventory $1,500, you credit accounts payable $1,500. And then they return $200. That will decrease the value of the inventory by $200. It will also decrease the debt by $200. So you do debit accounts payable and you credit inventory. Any questions?